You're about to make a mistake that could cost you over $50,000. And honestly, you probably don't even know it yet. Welcome back. I'm going to show you the 5 biggest errors that beginners make with index fund investing, and more importantly, exactly how to avoid them so you can actually build wealth instead of spinning your wheels for the next decade. Here's the truth. Index funds are boring. They're not flashy. They don't have the drama of day trading or the ego boost of picking the next big stock. But that's exactly why they work. The average person who invests in an S&P 500 index fund beats 90% of professional money managers over a 10-year period. We're talking real numbers here. Consistent 6 to 10% annual returns, compounding into serious money. But most beginners never get there because they sabotage themselves before they even begin. Mistake number 1. Waiting for the perfect time to start. You're sitting on the sidelines thinking, the market's too high right now. I'll wait for a crash. Meanwhile, you're losing thousands of dollars to compound interest. If you'd invested just $200 a month, starting at age 25 into a basic index fund, you'd have over $500,000 by 65. But if you wait 5 years, you're giving up $100,000. That's the real cost of waiting. Time in the market beats timing the market, every single time. Mistake number 2 is being terrified of losing money. Yes, index funds fluctuate. Your portfolio might drop 20% in a bad year, and that's normal. But here's what separates the wealthy from the broke. Wealthy people buy more when prices drop. Beginners panic and sell. You're playing a long game. If you're investing for retirement, which is 20, 30, or 40 years away, daily or weekly price swings are noise. They literally do not matter. What matters is that you stay invested and keep adding money. Mistake number 3, obsessing over fees. Listen, if you're paying more than 0.2% in annual fees, you're getting ripped off. A lot of beginners buy high-fee mutual funds or work with advisors who charge commission, bleeding away 2% of returns every year. Over 3 decades, that's the difference between $500,000 and $1.2 million. The solution is simple. Buy low-cost index funds from Vanguard, Fidelity, or Schwab. It takes 5 minutes, costs almost nothing, and sets you up for life. Mistake number 4, not automating your investments. Your willpower is finite. Instead of relying on yourself to remember to invest every month, set up automatic transfers from your checking account the day you get paid. $200, $300, $500, whatever you can afford, gone automatically into your index fund every single month. You'll stop noticing the money missing, but you'll definitely notice the wealth building. This is how passive income actually gets built. Mistake number 5, buying too many different funds. A beginner's dream portfolio is actually dead simple. 70% in a total U.S. stock market index fund, 30% in international stocks. Or, if you want even simpler, just pick a target date fund. It's one fund that automatically gets more conservative as you age. You do not need 20 different funds, or 17 crypto holdings, or some complicated strategy. Simple beats, complex every single time when it comes to building personal finance wealth. Here's what you do right now. Open an account with Vanguard, Fidelity, or Schwab. Takes 20 minutes. Buy a low-cost index fund, preferably something tracking the S&P 500 or total market. Set up automatic monthly contributions. Then forget about it and let compound interest do the heavy lifting. That's it. That's the entire system that builds financial freedom. Stop overthinking. Stop waiting. Start today.